In this short tutorial, we'll be looking at how you price and value a business. We'll be looking at two factors. First, we'll look at price to earnings multiples, and then we'll look at the price to sales ratios. First, what is a price to earnings multiple? Well, a price to earnings ratio, or PE, is how much a market is willing to pay for $1 of a company's earnings. The formula is current share price as the numerator over earnings per share as the denominator. For example, if a company's stock is trading at $50 per share and its annual earnings per share is $5, the PE ratio would be 10, or $50 divided by 5. This means investors would be willing to pay $10 for every dollar of annual profit. Now, let me try and simplify this for those of you who are not familiar with PE ratios. Now, you'll have to work with me on this, but let's say this cell phone is really a money-making machine. You put a piece of paper in one end, and out the other end comes a dollar, okay? Okay, question. What is this little money-making machine worth? Well, let's say we're willing to, pay $10 for it. And every year, this little money-making machine thing kicks out $1. Well, when you think of it, that's not bad. It's kind of like a 10% return. I paid $10 for it, and every year it gives me back $1. It's pretty simple. If you think of it like that, another way to think of it is that, in 10 years, it will pay for itself. When I started as a stockbroker in the early 1980s, price earnings multiples were down around 7 to 8. 10 was considered high at the time. Today it's a bit different. Let's look at the historical price earnings multiples. The historical average PE going back almost 100 years is around 15. Today we're around 30. Outside of recessions, these are the highest price earnings multiples we've had in history. Now, personally, I like the Case-Shiller PE ratio, or that index, so let's take a look at it. This is the Case-Shiller PE ratio. It goes back over 150 years. That's a long time. Now, as you can see, the average is around 15. Well, technically, the mean is 17.39 and the median is 16.1. But for simplicity's sake, let's just call it 15. The point being, it's currently over 42, the highest in history. The only other time it's gotten even close was after the dot-com bubble popped back in 2001. And that's simply because stock prices collapsed so fast that it kicked PE ratios up. Not because of earnings, but because prices collapsed. One of the other advantages of the Case-Shiller index is that it takes a company's average inflation-adjusted earnings over the previous 10 years. That takes out the one-year anomalies that can sometimes fake investors out, either on the upside or the downside. Next, we'll take a look at price-to-sales ratio. This is the price-to-sales ratio. Of all the pricing tools, this is the one I value the most in value in a business. It's really simple. It measures how much investors are willing to pay for each dollar of a company's revenue. It's calculated by dividing a company's market capitalization by its total revenue. Now, put simply, let's say a company has $100,000 in annual sales. The question, what is the company worth? Well, if the price to sales ratio is 1, it'd be worth 1 times revenue, or 1 times $100,000, or obviously $100,000. Now, if the price to sales ratio was, say, 1.5, then it would be 1.5 times revenue, or 1.5 times $100,000 in sales, or $150,000. Again, pretty simple. The historical average price to sales ratio, or PSR, is around 15. Today, you can see it's at 3.74. The point being, this is the highest price to sales numbers we've ever seen. Here's a problem that the PSR solves. In periods of high inflation, forecasting earnings can be really tough. Let's say a company's net profit margins are, say, 8%. If inflation hits, like we're seeing today with the producer price index up over 10%, when those costs float downstream, that 8% net profit margin can just get eaten up overnight by inflation. Now, having said that, when you price sales, you have less volatility on the margin than you do when you price earnings. Now, hopefully that makes some sense. Ken Fisher popularized the price to sales ratio all the way back into the early 1980s when I was a stockbroker. So today he's a billionaire, so it's obviously worked for him. I've tried to keep this as simple as I can, but you can get really complicated when you get into the weeds. And that's why it's pretty important to work with someone who does this a lot and who knows what they're doing. Now, for that, feel free to give me a call.